Hi, Adam Gower here, and my guest today, Phil Anderson, Director and Founder at Property Sharemarket Economics, is a recognized expert on the real estate market cycle and has written extensively on how to predict the next major downturn. You could call him an historian, actually, the detail with which he has analyzed markets to be able to make these predictions. But not only are you going to be learning about the state of the current market in today's episode and how to predict the next major real estate downturn, spoiler alert, it's not happening now, right, despite what some folk are saying. But you're also going to be hearing about Phil's new venture, which is to analyze the stock market in the same way as he has done commercial real estate cycles and to provide predictive analytics of how the market will perform. He's in the middle of writing a new book, and as soon as it's ready, you are certainly going to be wanting to buy that. To find out more about Phil Anderson and his research and reporting, go to the podcast page at gowercrowd.com, and while you're there, of course, be sure to click on the subscribe button at the top of the page to gain free access to our weekly newsletter, where you will learn about the latest real estate crowdfunding and syndication news and updates, and get information and resources that you can actually use. It's all there at gowercrowd.com. All right, now let's hear from Phil Anderson, Director and Founder at Property Sharemarket Economics. Here he is.
Phil, it's so nice for you to join me today. Thanks so much. I know that you're traveling and that you are in America today. So
yes, as it happens.
Kind of a closer time zone.
Much easier, yes.
You are the author of The Secret Life of Real Estate and Banking, and I know that you're transitioning into something else, and I do want to talk about that as part of this podcast. But before we do, learn a bit more about what you are looking at doing now. My first question is this. We've got this raging inflation, rising interest rates, like out of control, fastest pace of growth of interest rates for decades, a collapsing stock market, all kinds of geopolitical turmoil in the world. It seems like we are about to fall off the cliff as far as the real estate industry is going. That's certainly my call, at least in part for 2023. But you are the expert. Where are we in the real estate cycle? What are you seeing at the moment?
Yeah, I've had they're good questions. I've had a lot similar. You might find this a little bit hard to believe, but for the bulk of 2022, I'm losing my voice here. I've been talking all day yesterday. Sorry.
Thank you.
For the bulk of 2022, and you know, people do seem to find this a bit hard to believe. I actually thought 2022 has been so far pretty close to normal. As you know, I look at a lot of history and how markets look in the past. So if you go back, the key things I look back usually 20 years and 60 years and 100 years maybe. If you've done any decent study of the history of markets, which is what stock markets in particular, what I try to do, years ended in one and years ended in two. So, you know, let's say it's 2011, 2012, 2002, 2001. 1992, 1991, and so forth, going back. 2022 hasn't been anything abnormal at all. Just take the 20 years back. If you go back to 2002, you know, by October of 2002, the Nasdaq was down almost 80% from where it was the year before. And you know, I'm sure you could probably remember everybody back then. You know, nobody ever expected the Nasdaq to recover, let alone triple, quadruple from where it actually made the high the year before. And then if you go back to 1992, it wasn't so bad in the US in 1992, but in Australia and the rest of the world, they were dramatic years, 1991, 1992. I know.
Yes.
I was in Melbourne, Australia then, just opening up my office. The street that my office was in was completely empty, and 15% unemployment. It was high. But particularly if you look at 1962, just take the 1960 election. There was a young, new, brash Democratic senator called John F. Kennedy that went around practically his whole election speech was talking about how the USSR, Russia, was way ahead of the American defense fraternity, and he was suggesting that American had what he called a missile gap, which the Russians had so many more missiles than the Americans did. So he wanted to look strong on Russia, right? Well, I mean, that's pretty much what it looks like today. Back in the 1960-62, Khrushchev launched he said that Russia had a nuclear weapon and that America shouldn't mess with them. I mean, what's different today? I can't see that very much has changed. That was also, it was October 62. It was October 2002. And I can tell you, and I know, your viewers and yourself sometimes have a hard time believing things can repeat so accurately. But, I did tell all my subscribers and my readers that 2022 would be a tough year for stock markets, especially because it's a year ended in two. And things seem to go like that. It just sort of works in decades and 20-year and 60-year repeats. So from what I'm seeing, I was expecting US markets to come down into October. They have, and I think this is it. I think we've seen the lows. The stock market's going to bumble along for a few months. The Dow's doing quite well. Adam, I didn't think that the year was abnormal in any respect whatsoever. Now we have I know we've had interest rate increases. I think that the increases that we're getting, the American economy is going to deal with that better than some other places. The UK has been having a bit of a difficult time, but I have two rules about economics and the economy. First up, the Fed is almost always behind the curve, and the second is that the government can and does always make things worse. So you just have to expect these things, I guess. And the UK saw a bit of silly politics, really, that didn't help. So they will have a bit of a difficult time. But I'm not expecting property to crash, and so that means that the slowdown that we're going to get, which again I thought was moderately expectable, it's not going to cause, certainly in America, it's not going to cause real estate to crash. And because it doesn't cause real estate to crash, it won't bring substantial ruin to the economy, at least not yet. That's how I see it. And I just don't think we've seen the end of the so-called 14 years up, 4 down, 18.6 year real estate cycle.
Right, that's right. So the cycle is what is it, 18.6 year cycle? Yeah. Just tell us a bit about the cycle and where we are in it. As I recall, last time we spoke, Phil, you were talking about 2026 as being the year to expect, the really true crash to come, and that you also talked about mid-cycle turndowns as well. So just talk about the cycle itself, this 14 plus 4.6, and the mid-cycle effect.
Yeah, well, we've been over the mid-cycle. I write extensively about it, so anybody can get onto my free email address and just get some further information. But actually seeing it in operation is not always easy, because I mean, we have to say, you know, if it was easy, everybody'd see it, and you know, everybody take advantage.
If it was easy,
so,
everyone would be doing it, right?
Yeah. Well, and you know, I'm not naive enough to suggest that the cycle cannot repeat exactly. It just doesn't. It just doesn't work that way. We've got it rhymes, and you know, I said to you, years ended in two. If you look back 100, you can go back 100, almost 180, 200 years. Every single year ending in two has been either recession or a year that hasn't been up strongly. So people wonder where we're going. It's just, that's a normal part of what the real estate cycle is, and so you just get these. You can't have every year a good year, and you have to expect some of these things. When the Fed pumps money into the economy, asset prices go up. When the Fed decides to stop doing that, asset prices have to retrace. That's all part of the cycle. The general cycle is, as I've demonstrated in the book, The Secret Life of Real Estate and Banking, that you mentioned at the start. As a general rule, it's 18 to 19 years. You can't bank on that. It's just not going to be month perfect. But as Homer Hoyt demonstrated, and Roy Wenslick and others in the early days, it's never been shorter than 17 years and never longer than 21. It averages out about 18 or 19 years. And so that being the case, I think American real estate made its lows around 2011, 2012. That's pretty easy to see in the statistics. Not every state, but as a sort of a homogenous US price, if you can say that. I know the US is not homogenous. It is 50 different states, but as roughly, you know, mid 2011, 2012, that to me gives a clear 14 years up. Since 1955, it's been pretty exact. So I think we've got a few years left yet, but clearly, with the interest rates at the moment going up as they are, the rate of change in the real estate prices, it has to slow down. And plus, as well, what I think you're more than likely to see with the pandemic effect, when people went ahead and those who could afford it exited some of the city markets and took up property in the more regional centres. Everybody did that all at once. And I think there's going to be quite a few of those people to start thinking about now, to say, well, you know, it was nice being in these country regional centres, but actually cities have a lot to offer. Maybe I ought to go back. So that has to unwind in certain instances. You know, you can't, you know, there'll be certain regional centres they just have to see price falls of some sort as that unwinds. The final thing I can say about that is, and again, it has staggered me with all of the US economists in particular, when they've suggested that interest rates rise as they have, property prices must fall. Now, they may or they may not. I don't have a magic crystal ball that tells me what's going to happen tomorrow. I just basically assume that history repeats and the Fed's behind the curve and the government's always going to make things worse. You know, if you look at the historical fact, back to 1955, the Fed has lifted interest rates 11 times. You can go back. You can think of 1994, and there was a California pension fund collapse back in 94. You can look at about I think it was 86 to 89. You go back from 1974 to 1979 or something like that. Do you know that if you look at those instances where the Fed has lifted interest rates in those sequences, every single time except once, US house prices continued to go up. And in fact, between 1975, 6 or something into 1980, US interest rates rose from about 9% to actually to 21%. I mean, can you believe that? House prices went up 100 and something percent. They doubled. So it's not correct to say that just because interest rates go up, house prices have to crash. The historical record doesn't bear that out. And I've just been staggered and amazed. There hasn't been one economist anywhere in the US that has actually pointed that out. It's astonishing. So no wonder people start their fear level starts to rise. No wonder they can't work out what's happening, is because all they see is what's being reported. And what I've been able to do over the years, for all the people that have followed me actively, what I have been able to do is to show people that the economy does have a structure. It is based on what I call, in a strict economic sense, it's the economic rent. It's the earnings of land capitalising into a price from which then the banks can then create credit and then bring forth a mortgage. So the banks are actually monetising that earnings of land, and when the more they do that, the higher land prices are going to rise, and that's the cycle. And once you see that, the people who do see that, they learn that economic structure can give you an enormous amount of relief to know that that's how it works. And the thing you also have to learn about that is, unless you're a land economist, this is going to escape you. You're simply not going to see things. You just don't see it. And that's why people continue to live in the fear base that everybody else subscribes. And it's why mainstream economists will never tell you that it's not necessarily true that just because interest rates go up, house prices are going to collapse. So it's interesting times. I'm not saying these things are easy, but I think a reasonable study of history and an understanding of the structure of the land market can be enormously useful in helping to frame your investment decisions over the longer term.
Phil, so when we scheduled this call, I understood that you were moving away a little bit from real estate. I mean, you are a recognized expert. Your book is one of the foremost thought leadership pieces that anybody can buy, and I'm going to put a link to it on the podcast page. But yes. I know that you are interested in and beginning to look at a different direction, aren't you? W.D. Gann. Tell me something about what that is and what's evolving over there.
Yeah, it's funny. I wrote my book about real estate. Where do I start? Gosh, there's so much to say. I wrote my book about real estate, and that's sort of what I became known for. But actually, what I'd been doing all the years before, and what I really wanted to do, and I want to get back into, is this study of W.D. Gann. Now, he was a great American investment and trader from about 1900 to about 1955, 56 or so when he passed. He's easy to Google, but probably the wrong things come up about him. Really, the internet these days is it's becoming a bit like an echo chamber in a way, and I don't think necessarily.
Really?
Yeah. I'm not sure people are getting exactly always the right stuff. So
really,
but
I'm so glad that you've noticed.
Yeah. So in brief, Gann did a great study of stock markets, and for those viewers at the moment, if you've ever studied a stock chart, you may have noticed that there's actually two axes. There's one for price and one for time. Now, there must have been hundreds of millions of chartists over the years. Absolutely no one except Gann asked the question: what happens if you actually make attention to the time axis rather than the price axis? Okay. And Gann discovered, or rediscovered really, that there are certain cycles that you can apply to markets that seem to work, and it gives you an ability to think about and perhaps better forecast. And even better with Gann, he taught people how to actually trade a chart, how to understand or read a chart, can improve your profitability. And Gann went ahead. Fortunately, he wrote quite a number of books, and his particular book, Truth of the Stock Tape, I'd encourage anybody to read it. He published that book in 1923 and told people that you should basically always get into stocks that have good momentum and buy key levels, key breaks. And he published that 1 year before the US market went on to produce the greatest bull market of all time up to that time. So if you followed Gann like that, many of his subscribers made prodigious amounts of money, all based on time. You see, all based on time. And Gann, and this is where I got this year ended in 2. Gann clearly showed back in history that every decade has pretty much a rough guide. So years ended in 1 and 2 are basically sideways after an up move the prior decade. Years ended in 3 make a recovery. The recovery then, years ended in 4, years ended in 5, usually a very good year. And year ended in 6 and into 7, where we get a bit of a usual, the year ended in 7, October, years ended in 7, we get a bit of a collapse. And I'm expecting that to repeat in some sort of format. He was a very interesting chap. He's not really very famous because, he didn't drink, he didn't smoke, he didn't seem to have any sex scandals around him. So
no vices.
Yeah, so he didn't make the papers all the time for that sort of behaviour, but he knew what he was doing.
What are you doing, Phil? What are you doing? What analysis? What research? And are you working on a new book?
I want to show people in a more simple format, easier to understand, just what Gann discovered. I also one of the reasons I'm in the US, I am going to do a bit more of a stock, sort of like, it's not a stock picking service, but sort of like a service that how people can understand more about the stock market and what sectors move when, what stocks are likely to move when. So for example, for me, if the real estate cycle's going to be set to continue, some of what happened in 2022, I felt had to happen. We can't get a much bigger move up into 2026 unless banks can create a lot more credit. And the way the banks can create a lot more credit now is they have to get a bigger spread. So in other words, they have to be earning a lot more from mortgage rates than what they're paying to depositors. And that wasn't the case in the prior decade. But now, and as you're seeing, if you're watching the stock market closely, banks are beginning to report bigger profits. And once they do, one of my strengths is most people are either they look at the stock market or they do real estate. They don't tend to do both. But I do urge, if you're in the real estate market, I do urge you to try and understand a little bit about the stock market and how it moves. And for me, for the real estate cycle to continue, what we should be seeing at the moment is the stock prices of American banks moving upwards. And if you're looking at that, if you look at the new highs list published every day, quite a number of regional banking stock prices or the companies are beginning to move up. They're hitting new highs. So it gives me confidence to suggest that those banking areas, the banks themselves, be able to start issuing more credit. Yes, it'll be at higher mortgage rates, but I don't think that'll change much. And then that's how the cycle just continues to move. I hope that makes sense. That's the only way I can describe it. But once you sort of see the effects of land and banks and credit and the cycle, it's all pretty much normal to me at the moment.
Yeah, it's interesting that you say that, because banks are rapidly increasing their lending rates.
Yeah.
Very, very slowly, if at all, increasing their deposit rates. So they're clearly making more money.
Yes, and they're reporting higher profits. It gets a bit disguised a little bit at the moment because their investment units, are struggling with the markets and with the takeovers that the banks fund and things that the lending that they do for that. But once that all sorts itself out, I really think there's quite a lot of banking moves to come.
Yeah,
and once you get more lending, more credit, how that assists the movement of the market again.
Well, that's exactly right. And the whole point of the Fed's, or the reason that the Fed is increasing interest rates, is to reduce liquidity. It's too much liquidity, especially after all of the stimulus that we've seen over the last few years. And so by increasing rates, what we're seeing, at least in our world of real estate, banks are becoming incredibly reticent to lend. It's becoming much, much harder. So liquidity is clearly drying up in the market. How will that resolve, even if they are making more money, if they're not lending?
Yes, that that's reasonable at the moment, because the banks actually can make more profits at the moment. I think probably by not creatively lending. That it's normal they'd be prudent at the moment. They don't. They do want to see not better lending standards, but want to lend to people who they think they can actually pay it back just at the moment. So yeah, I'd say that's normal. I think that'll unwind as things become a little bit clearer towards the end of the year and into 2023, and certainly in the US as I think, in my opinion, becomes clearer that the downturn isn't going to be as dramatic as some people seem to think. At the moment, from what I've seen around the US, heck, Adam, flights are full. Every single flight I've been on here, there is not one seat empty. I don't ever recall being on so many flights where there's not even one seat available.
That's incredible.
Some of the airports have been busy. Perhaps perhaps not as busy as they used to be. There's the queues aren't as long as I remember pre-pandemic, but where I've been around, the restaurants are busy. There doesn't seem to be a lack of spending, and they do just about everywhere seems to be short-staffed. So clearly the pandemic has altered people's perceptions of what they want to work and where and how much they're prepared to accept. But it's hard for me to see some significant downturn when you see.
Right, and your point is that the underlying economy is still extremely strong.
Yeah.
Despite everything that's going on.
Yeah, well, I think so. It's just, to me, it's just a normal repeat of history. Years ended in two have always been tough. Like I mentioned before, you look back at history. I mean, can you imagine now if the Nasdaq went down? Was it 79%? I think it went up in 2002. I mean, they were much bigger moves. I remember being in that myself. Everybody came out and said the Nasdaq had it. The US had it. That the technology had peaked. There wasn't going to be any further inventions because just about everything else everything had been invented.
Been done.
And then along comes the iPhone in 2007, and then after that along comes Bitcoin and stuff, and away we go. So I would never attempt to short sell the United States. It's a very dynamic place. The flights I've been on, I'm always up the front of the plane, so I don't know what's going on down the back. But in those business class seats, practically always of the 10 or 12 that might be there, there'll be as a minimum half of all the people that are on it, usually 3/4. They're all madly on their laptop, their iPhone. They're busy working it, and it's a productive place here. It is. So I'd see this current year as a great opportunity if you're well placed.
Do you think that, to what extent do you think the pandemic has changed the way people invest and work and live their lives?
Well,
and the impact that will have on stocks and on real estate and on investment in general.
That's an interesting point. It's a good question, and I've been told. Look, I know I see things a little bit different to most others, but now this don't take this the wrong way. You would never wish a pandemic on anybody, but if ever there was a country that I think needed a kick in the ass, it's the United States. Let me tell you what I mean by that. When I was writing my book, and I spent a good number of months and if not years going around through the Midwest and then the Texas Panhandle and through California. I had a friend with a great office in San Francisco. But I distinctly recall only, not that long ago, not less than a decade, even a couple of years back, I distinctly recall you'd get into a taxi in Texas and the only way you could pay for it was with cash. You'd always see people walking around the United States with wads of cash, right?
That's so true. Yeah.
Yes. Well, you can't. That's changed, and when I was doing that, I used to think to myself, because I was in Australia or France or parts of the UK, I would have a credit card that you could just not necessarily tap so much, but you'd put your card in and a certain value, you wouldn't have to do anything. And in Australia, you know, your credit card was just so easy to use. And I used to get to the US and I used to get so annoyed because I'd have to be carrying cash all the time. You'd be walking in the restaurants and, you know, similar stuff would happen. The US has moved forward. It really has. And I just felt it had this, I just felt that the US was, I know this is hard to say, but because US is, you know, it does some creative stuff, but you were behind. You were behind a lot of what Australia was already doing. Not now. Things have moved forward. And I felt that the pandemic, as one of the reactions, it forced a lot of people in the United States to actually move into the 21st century properly. I think this is going to be very, very productive and very positive for the US economy generally, because you are now beginning again to lead that movement. You know, don't get me wrong. You know, you've been very productive in Wall Street's been very creative, and you know, the crypto and all the other stuff and everything that you can do. But I just felt there was a lot of backorders around the US that were still in the 19th century a decade ago, not anymore.
So is the point that you're making that the pandemic kind of forced people to use tech and tools to make remote life and work? It just forced them to use that significantly more.
Yes, we'd been doing that already in Australia and a good deal of parts of the UK. You know, nobody was working from home, so that's been a big change worldwide. But certainly in parts of Australia, you know, even New Zealand, I thought we were ahead on our tech use. Not now. Most people have got used to that sort of thing, and they've been happy to swap to be working from home. But to do that, you've got to actually be better on your tech. And I think that the country that's going to be the biggest beneficiary of that going forward is definitely going to be the US. So positive, I think, in a positive way.
And what about so what are your thoughts about the impact? You talked about the iPhone. It was funny that you should have mentioned the iPhone, because that really, you know, the idea that we now carry these devices that provide us with access to, you know, everything in recorded history.
Yeah.
Right, yes. and yet we select to spend time on it looking for funny cat videos.
Yes,
but more importantly, what's happening is that we're also able to select the news and the inputs that we get from the world around us to reinforce our own worldview. Yes. And that this is creating an ever-increasing split in society. It's not just a US thing, obviously. Yes. This is happening around the world. What do you see the impact of that being on investing patterns?
Well, hence we get a cycle. Again, I don't see that as anything new. It's perhaps more pronounced now and maybe a little bit more violent, maybe. But you know, you go back in history, you look at the Americans, you know, in politics in the past. You may remember that. Well, it's a long time ago. I put it in my book. The rise of the people who were called the Know Nothings back in the US history. You know, they were dead set on their version of what the US should look like. It was religious based, really, and no Catholics. I mean, you know, if I've got my history right there, it's not really a great deal different to now. To me, it does seem that in one way, all the new technology that comes along, it doesn't seem to make us always much smarter in a way. It does for many of it seems to reinforce what our existing biases are, which doesn't help. But that's how I see the cycle. You know, I can't see that it's greatly different, really. You know that. You know, if stuff wasn't in the mainstream and was really hard to find pre-internet, it's not on the internet now. So the stuff you really need to see, I've said this before, the stuff you really need to see is get an old history book and actually go ahead and read it. Don't get somebody else's opinion. Find it somewhere, even if you've got to borrow it from a library, and actually read a bit about what was happening. I think it'll make people a bit smarter.
It is interesting, isn't it? But
Yeah.
I won a debate at high school one time because I quoted Billy Graham. I'm going to quote him
Yes.
again now, the evangelist.
Yeah.
He said that technology is merely a more efficient means of going backwards.
Yeah. Yes. Yeah. Sometimes that happens. Yes. I mean, don't get me wrong. I mean, I don't want to go back. My son is 21 now. I can tell you, I wish I was 21 again. I mean, the things they can do now with their phone, right? All the services that are on it, the apps. I remember the fear that that we parents used to have when the 2007, 2010, about when the phone first started. And all the kids were actually couldn't get off it. Remember the fear that used to go, well, we thought that the kids would end up absolutely lonely. My son's got more friends than I ever had. He can dial up and see what people are doing. He knows everything. His friends. He can keep in touch with people absolutely everywhere around the world. It's as if they're in their own house. He can choose the time of day when that wants to happen. They're all getting together, or they all handling stuff. My son's listening to music. He's doing his emails and he's updating his apps all at the same time. I can't do that. They've just learned different skills. I'm stuck with just doing one thing all the time, and if it gets to too many stuff, I have a meltdown. So it's great, so I would not like to go back to how it was. But in some instances, it's not making us any smarter at all, and that's a bit of a shame. And it is demonstrating this in the US a bit, where you've got some preposterous conspiracy theories happening at the moment, which have always been there, but that's not helping with the whole.
Well, this is this point that you made again of the echo chambers. You just kind of you silo yourself in an echo chamber that reinforces your worldview, and if that worldview is removed from reality, I mean, this is more of a philosophical question, Phil. But what is reality? I'm going to tread into some iffy waters here. But what is reality? Reality and truth is that you see it to be.
If you think something's true, then it is.
Exactly.
I'm not sure I have answers to that, but what it will do is as we drive further into the real estate cycle towards the end, the people who need to see it, the mums and dads, they're not going to see it. They're not going to see the end. Hence, that'll reinforce their worldview that the system's against them, and that there's some guy sitting at the top, or a banker or a politician at the top, that actually deliberately trying to make them poor, when it's just this land cycle. And it's important. I've always felt it important that some of the key people that really need to understand this is, you can, if you're not aware of what the cycle is, and if you're born at the wrong time, you're going to be destined to buy a house at precisely the wrong time, right at the top. It's a life decision you make. And for some people, after 2024, it's going to ruin their life, because they'll end up with poor, bad equity, and they'll blame the system and society for it, when in fact, really, they're in the system, and they've just got to do more to understand what it's all about, and not get stuck in all these ridiculous conspiracy stuff. It doesn't take you anywhere. It's just you just go down a rabbit hole.
Phil, I have to ask you this question, right? So you're a recognized world expert on the real estate cycle. You're now starting to, well, not now, but you're beginning to focus now on stock markets and WD Gann, etc. So you're an expert in investment. I got to ask you one question. What is the secret life of Phil Anderson's investment portfolio? Right? What are you investing in today?
Well, it's the most important thing I've invested in my family and son. I've passed on a little bit of bank accounts to him now. I think his eyes popped when he saw one of the figures, because he's only a kid. But I've told him that that can only be used by him to buy a house when he's ready. I've also told him that he's of the generation that will probably be married and be under pressure from the wife to actually buy a house. His average will be around 25, 26. So I've tried to tell him, and he knows that those are the years he's got to be careful. So first thing is to invest in those around you. It depends. If it's your first house you're getting into and it's your own, just get in the market, because being a homeowner brings your worldview slightly different, and you've got to understand how home ownership works and what it does. After that, give yourself an investment in one or two very good books, of which mine is one, How to Understand the Cycle. Also one or two others to just educate you about what happens.
Any recommendations, Phil? You did mention one earlier, one of W.D. Gann's, but any others that?
I think Martin Fridson's book, It Was a Very Good Year. That's a very good book. That'll teach you when and why the US stock markets have their good years, and it's very much related to money. That's another one. That's an absolutely essential book to have in your library. You've got to read that book. And then, once you start reading that book and mine, if it interests you to do anything further, just have a look at the book references I make in my book and that Martin makes. I've never met the guy, but it was a good book. If it interests you to follow up with some of his references, then you sort of get into areas where you think you need to learn more, and you go from there. Always remember that it's in the buying where the profit is. You've got to buy right, and that's the most important thing, because if you do that, you're well on your way.
Phil, I just noticed the time. I can't believe the time has gone so
it's gone quick.
Let me, and I hate to do this because I just want to sit here and chat with you all day. I know you've got a busy day, and I really appreciate your time. Let me ask you 3 rapid-fire sign-off questions. How about that? I ask all of my guests the same thing. So the first of the 3 questions, what are your daily habits that keep you successful and productive?
Never believe what somebody tells you. Well, number one. Yeah. Okay. Also be do be careful who you're going to business with. That's probably been one of my biggest learning lessons. I've been too trustful sometimes.
That's interesting. Actually, was my second question. What's the hardest lesson you've had?
Yeah.
Well, I was going to say actually the hardest lesson in real estate, the hardest lesson in business.
Yeah, no, be careful who you go into business with. You have to know more than you think you know about them. Yeah, that's been my biggest lesson, without doubt.
My last question, rapid fire question today, for somebody, an average investor, what advice would you give them about the markets and where to invest and what to look for?
If you're talking real estate, just get in. And then if they're making a first investment, just get in, just do it. But you don't put all your life savings into that. You've got to have some sort of backstop where you can recover if you make a mistake. If you're talking the stock market, you do have to understand that the easiest way to make $1 million in the stock market is to start with 2 million. I've said that before. Stock market will take your money if you don't know what you're doing, because the stock market almost always, even for people who've been in the market a long time, it's very difficult to trade over without your emotions, because your emotions are not helpful. Then it's all right in the housing market because mostly our prices go up all the time, but unless at the last couple of years of the cycle. But the stock market can be deadly if you don't know how to deal with your emotions, because you'll make your decisions based on your emotions, and those decisions, if they're based on emotions, will always be wrong.
Phil Anderson, author of The Secret Life of Real Estate and Banking, and soon to be another book.
Yeah, I hope so, yes.
Just an enormous pleasure. Fabulous seeing you again. Thank you so much for spending your time with me today.
Yeah, my pleasure.
That was Phil Anderson, director and founder at Property Sharemarket Economics. To learn more about Phil and Property Sharemarket Economics, go to the podcast page at gowercrowd.com and be sure to sign up for our weekly newsletter. It's totally free, where we publish news and updates from the online real estate syndication and crowdfunding industry, and provide you with resources that you can use to improve your own capital formation processes, as well as to learn how to become a better investor. All right, Phil, thank you so much for joining me. Oh my goodness, what a pleasure it was to see you again. Can't wait until your new book is ready, so let's stay in touch and revisit once that is published. And thank you too, dear listener. I hope you found today's episode as interesting as I did, and are also longing to hear about Phil's new book as soon as it's ready. All right, that's it for today. Be well, stay safe, and for now, this is Adam Gower signing off.